Options income trading involves combining short and long options in ways that create ranges of prices, both up and down, where you can enjoy an options trading win and sometimes a substantial win as long as the market remains inside that range. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders on our desk are expert at initiating and managing these kinds of trades. So in this video, we're going to show you a simple technique for expanding that range into a substantially wider range if the market makes a move outside of the original range. So if you're interested in a technique that provides you with an extremely wide range of prices over which you can win an options income trade, then stick around. I think you're going to be able to pick this one up pretty quickly. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so as some of you may know, the kind of trading that we practice here at SMB's options trading desk is known as options income trading, and it involves trading in large ranges, usually around where the current price of an asset is, creating the potential for a solid winning trade over sometimes a very large price range around the current market price. But there are, of course, cases where the market breaks out of that wide range, and there must be techniques for widening the range so that the trader can still win the trade. Now, the example that we're going to show you involves trading index options in the Russell 2000 index. And so before we jump into the example, we need to make sure that everyone watching understands how index options work. If you're already familiar with them, then hang in there. This will be quick, and then we'll jump back into this specific example that I think you're going to find enlightening. Okay, so now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires. And a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except that there's no such thing as 100 shares of an index like the Russell 2000 index. You can't really buy or sell 100 shares of an index, but what you can do is get paid in cash $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, if the RUT index which is the Russell 2000 index, is trading at 1350 and you buy the 1360 call, if the index closes at 1365, you'd receive $500 in cash in your account. If the index closes at 1360 or lower, on the other hand, your call expires worthless. On the downside of the market, if you buy a 1335 put and the market sells off to, say, 1325, you'd make $1,000. But if the market just sold off to 1335 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well. And your broker will also allow you to put together combinations of options. In other words, option strategies that involve both short and long options purchased in a way that are advantageous to you as a trader. Okay, with that said, now let's say that we had decided to enter into a 1-month trade on the Russell 2000 index, which was trading at around 1490. So let's say that on August 3rd, you sold 4 of the 1490 calls and 4 of the 1490 puts, the at-the-money options, in other words, for the August 31st expiration. So this is going to be a 1-month trade approximately. Now, you'll need to protect those short options, so we're going to head up 100 points to the 1590 call and buy 4 of those, and head down to the 1390 put, and we're going to buy 4 of those. Now this combination, this strategy, is known as an iron butterfly to options income traders. Now before we get into how we're going to trade this strategy, I wanted to let you know that there are lots of sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use. Go ahead and click the link that should be appearing right now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose the video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Back to our iron butterfly, let's first analyze what has happened here from a cash flow perspective to understand how this trade works. So let's take the 1490 short call. Well, we've sold that one for $48.85, but remember, each point above 1490 is worth $100. So we multiply that by 100, and we sold 4 of those. So doing the math, our total income from the call is $19,540. We also received $19,220 for selling the put by the same logic, and then we had to go out and buy the protective call for $42.60 and $72.40 for the protective put. So if you crunch the numbers like we did there, you'll see that the total initial cash flow from the trade is $27,260, and your broker will require you to put up $12,740, so you have to make sure that that amount is in your account if you want to do something similar. That's your worst case scenario on this trade at this point, incidentally. Now, I'd like to show you one more thing before we move further into the trade, and that is that options traders rely on graphs like this, which define the profit or loss depending on where the index ends up on expiration day. We've explained this in another video, and I'd like to avoid getting bogged down on how this is calculated in today's video, but for the purposes of this example, just accept that mathematically, if the market sells off below 1422 or above 1557, the trade would lose money on expiration day. And the reason we're mentioning this is that many options traders like to pick those break-even points as a line in the sand for the trade, beyond which the trader will modify the trade in order to some way extend the trade profit range on the side of the trade that needs the extension. Okay, so now let's move forward to August 7th, 4 days later, and as you can see, the index has moved up quite a bit to 1554, which is 64 points from where it was trading when we initiated this trade, and it hit the area which defines the upside break even on this trade, and so we might want to do something here to extend the upside profit range. So what we can do is to buy what is known as a call butterfly, where we buy 4 of the 1490 short calls that we originally sold, which closes those out, and that is no longer part of the position. We then sell 8 of those 1590 puts, which closes out all of those 4 options and turns that strike into 4 short calls, and then we move up 100 points to the 1690 strike and buy 4 of those calls for protection, as we did before. Now, once we do that, the position now looks like this, with the put side, as you can see, being untouched, but the call side is now 4 short calls at 1590 and 4 long calls at 1690. Now, as you can see from the calculation, the cost of the call butterfly is $16,540, and so we need to subtract that from the original iron butterfly income that we received originally in order to take stock of our new position, which still retains $10,720 in cash after deduction for the cost of the call, as you can see. Now, this new position, incidentally, will require some more capital. As you can see, a little bit over $20,000. So please be aware that these adjustments come with added capital requirements in many cases. And so what this has done is to extend the upside profit range of the trade by 60 points up to 1617, which may be very helpful if the market continues to rally. Okay, so now let's move forward to the day that the trade expires, which is on August 31st. And as you can see, the Russell 2000 index closed that day at 1568, which is a full 49 points inside the profit range. Now let's break down exactly what happened here. Well, as the trade is expiring today, we can assign a value to each of these options. And as you can see, that's pretty easy because each of the options in our adjusted position has expired worthless. That's because the 2 calls at 1590 and 1690 are worthless because they only pay off if the market has gotten above their strike prices. And so the result is that all of the options die, and the net cash flow from the trade, after deducting the cost of the call butterfly, that $10,720, That becomes our profit on the trade because none of the options have any value, and none of the options that we sold created any obligation on our behalf because they all expired worthless. And so our profit is our cash flow. So think about the implications of this. Our final position required capital of $20,080, and the trade resulted in a profit of $10,720, which comes to a return of over 53% in less than a month. And so what I'd like you to take away from this video is that options income traders, like the professionals on our desk here at SMB, have tools at our disposal to set up options trades in very wide ranges. But then, if need be, we can extend those ranges substantially and still have incredible profit opportunities available to us as long as the market takes a breather and doesn't just keep running, as of course may happen sometimes. But more often than not, the market attains new levels and then consolidates at those levels, as happened in this case, resulting in an awesome profit that can result in many cases once you learn the tools of options income trading. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you're going to be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on our subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.